And I want to now introduce very quickly our first speaker, Jimmy Weng, you can see him up there on the screen. He's a Northeastern alum, graduated summa cum laude from Northeastern, I think in 2000, when was it, Jimmy? I forget, it's about 10 years ago. Yeah, about 2007, I think. And then he worked in co-op in Morgan Stanley in Hong Kong, went to HBS, got his MBA, went back to Asia, did his own startup, and now works for a joint venture between ICBC, which is the largest bank in China and the largest bank in the world, with over $4 trillion in assets. They have a joint venture with Credit Suisse Asset Management, and he works for them in Hong Kong. So he's looking across Asia and is going to give us an overview of the rise of Asia. Jimmy, take it away.
Okay, great. So let me pull up my presentation first and make sure that you can see that as well. All right, so well, thank you, Ravi, for the opportunity to speak and also for the opportunity to be back on campus, at least spiritually. So I did graduate 2007 from Northeastern and been out in Asia ever since, based in Beijing as well as in Hong Kong. Now, Ravi asked me to speak about the rise of Asia, and I've been out in Asia for over 10 years now, focusing predominantly on the China markets, but also looking at Asia as a whole. Through ICBC Credit Suisse, we are predominantly managing equities, fixed income, and money market funds. And I wanted to talk about Asia from a market perspective. And I think the best way to do that is really give you a more general framework in terms of how I want to present this to you. So the lens of how I see Asia is through first the macroeconomic conditions. Macroeconomic conditions generally will be able to lead into earnings growth. Earnings growth thereby will lead to fund flows, and fund flows generates the share prices among the various markets that we're invested into. So I think to begin my presentation, I wanted to start first with the price side and let you take a look. Since 1990, U.S. and Asia ex Japan has been through various super cycles. Now you could see the first cycle in early 1990s, Asia was actually outperforming the U.S. by 129%, followed by the U.S. outperforming Asia by 190%, followed by Asia outperforming by 347%, then the U.S. And what we believe within ICBC Credit Suisse and myself through the research that we're doing is that Asia is starting the next super cycle. This super cycle on average has lasted about 6 years and has generated over 100% outperformance. So this is not the performance, this is really the outperformance relative to the other markets. So beginning in the early 2017 till now, so roughly about 1.5 years, Asia is so far outperforming by 18%. And I think that in the past month, given the turmoil situation regarding the concerns about U.S. rate increases, inflation, dollar, that's generally been coming down a little bit, but we're still very bullish on the long-term trend for Asia relative to the U.S. going forward. U.S. market, you could see on the top right-hand side, U.S., Eurozone, as well as Japan, real GDP growth is expected to stabilize below 3% going forward beyond 2020, while the real GDP growth for China, India, particularly, is expected to grow above 5%. Beyond 2020. And I'll break that down a little bit in more detail and also talk about where the contribution is coming from in terms of the overall GDP. So the macro backdrop you could see here, it's still very much a global growth story. We're still seeing that real GDP growth is growing about 3.9% for 2018 and 3.8% for 2019. And this global growth, if you break it down between emerging markets, Asia ex-Japan, Latin America, and also the G10 countries, you could see that Asia ex-Japan is really leading that growth for 2018, 2019, and also going forward. With Asia ex-Japan about a little bit over 6% for both years, emerging markets growing on average about 5%, while the G10 countries are growing about 2.4 and 2.1%. Overall, assuming that there's no tail risk events in the coming several years, we're expecting that industrial production and also real GDP for the global economy is going to remain stable, while inflation pressures would likely be maintained at a relatively low level, and I'll go into that a little bit more detail later as well. Now, I mentioned about global growth, global situation, but I think this story is really about the rise of Asia, and you could see that the contribution to the global GDP growth is really coming from emerging markets, ex-Japan as well as for Japan, while developed markets beyond 2018 is expected to decline. And we believe that this is actually quite sustainable going forward as well. And this is really due to two reasons. One is that the emerging market ex-Japan headline inflation on the right-hand side, you can see that the yellow line is slowly trending down. So a lot of the emerging market countries don't have the same pressures that you had back in 2013 to raise rates, really to contain inflationary pressures. While at the same time, you could see on the left-hand side, the emerging market ex-Japan current account balances as a percentage of GDP has actually much better situation than before. So I think that the macro backdrop for emerging markets, as well as the growth going forward relative to developed markets, is actually a very strong story. And real GDP contributions to growth, I think that when we talk about emerging markets, the two giants are China and India. You could see the real GDP trend across both. And I think that the more important detail is behind what makes up that GDP. So for China particularly, just given that we're managing a large China portfolio, you can clearly see on the bottom left-hand side that investments are actually shrinking as a percentage of that GDP, making up relatively less than 50% now versus back in 2013 when this is clearly above 50%. So what's really going to buffer that is one, the net exports is essentially supposed to improve slightly and also make some buffer some of the cushion where you're making losses within the investment side as the government tends to deleverage. But also you're seeing that consumption, both household and government, is actually very, very strong. So I think that China is going forward going to be a China consumption story where investors are going to be looking for the rising middle class, the rising wealth, the spending, and that is going to be the contribution for China's GDP growth going forward. India, you could see on the bottom right-hand side, for the latest figures that we have, is actually a mix between consumption as well as fixed income. Now, when you think about Asia as a whole, you can also see that private consumption across various emerging market countries are actually very, very strong. Actually, private consumption accounts for about 40 to 50% of Asia ex-Japan GDP numbers. And you could see the Philippines, Vietnam, Hong Kong, India is actually very strong in terms of the private consumption numbers. What's more importantly is actually that consumption growth that I was talking about. So you could see from 2018 expected figures in 2019 that a lot of these consumption growth numbers are actually higher than the expected real GDP figures for these emerging market countries. So that's actually refocusing back on the domestic consumption story. While investments and exports, you could see here, various countries are still actually very much focusing on improving their infrastructure, government investment, improving bottlenecks within the system. And that's particularly related to, you could see in the Philippines and Indonesia, Vietnam, a lot of the emerging countries with very strong growth are actually having various bottlenecks. So I think that infrastructure and government spending there is going to be also a very big part of their growth going forward. And finally, Asia exports. You could see that right now there's a lot of talk about trade wars, and I think Asia is predominantly affected by this because you could see that Asia exports to the U.S. is actually one of the largest compared to exports to the EU, Japan, and also to China. So that actually has a very large impact in terms of what's going on currently, and I'll go through that in a little more detail. Now, very quickly also, the inflation forecast and the targets. Generally, the quick takeaway here is that many of the emerging market countries actually have headline inflations that are below the federal central government's target and forecast, except for India, Indonesia, and the Philippines. So thereby, you might have some pressures among these countries where you'd be forced to raise rates, but other countries, including China, including Malaysia, and including Thailand, you're seeing that the government has a lot of room to work. The central bank is allowed, they can maintain rates at a very low level, so then thereby stimulate that growth. So I think that this is really give you a sense of where the inflation figures are, where the central bank targets are, and how much room do they have to continue stimulating the economy. Now, I mentioned earlier about the trade war currently in this market, and we read about this every day. I read a lot about Trump, and I read a lot about the trade war between U.S. and China. And what I've been talking about this, particularly with Ravi as well, is that, in my opinion, it's not necessarily a trade war. It's really a tech war. Now, I think that if you look at this slide, you can really get a sense that China is really moving up that value chain. R&D spending is actually now higher than the UK, and it's continuing to increase now over 2% of GDP. International patent applications now are actually surpassing Japan and is only trailing the US. So in terms of innovation, China is really leading that R&D research investment. And I think that is one of the key concerns among this trade war, not particularly on soybeans or pork bellies or clothing, but particularly on the technology. And I think winning that R&D technology race is going to be key to being the next superpower country going forward in the future. Now you could also see, share of world-class high-value exports. Now China is no longer just an exporter of cheap goods and cheap labor. In fact, they've actually moved way beyond that in the value chain, while the total factor productivity relative to other emerging market countries is actually very, very strong. And on this slide, you can see relatively to the U.S. and other countries, the R&D spending amount from 2007, which was about 49 billion, to about 265 billion as of last year. China is actually catching up, now only trailing the U.S. in terms of R&D spending. So I think where we're talking about trade war, we need to also connect that with a tech war, where the U.S. is really trying to slow down the pace of this, which is what's happening in the current markets. Now, how does this all translate back into the markets? Well, what we do is we're also tracking, for example, emerging market listed equities, and what's the revenue exposure of these listed equities to the U.S. market. So you can see on the left-hand side the exposure by country. So you can see Taiwan, Mexico, and Japan having some of the largest exposures, where the end market is the U.S. So they're thereby susceptible to U.S. protectionism risk. And then you can also look at some of the key sectors that are particularly vulnerable as well. So you could see IT, energy, consumer discretionary, which is predominantly autos, as having a lot of revenue exposure to the U.S. And thereby, if we see a tariff or an increase in tariffs and a trade war, these are some of the key markets and the key sectors that would be susceptible. And also, when I talked about how macro leads into earnings. Now, earnings essentially are how we forecast that, and also a lot of sell-side analysts, they're looking at earnings growth and they're forecasting that downward for the next year. And a lot of that is, focusing on PMI, FX, utilization rates, 10-year bond yields. And we're seeing also the EPS trend being revised downward. We're still seeing a 4.5% EPS growth and 8.4% growth for 2019 and 2020 for emerging markets as a whole, but we are seeing that trend come down just given the uncertainty among the trade wars, among the PMI surveys, among businesses who really don't know what's going to be happening next, and what also how the inflation looks like and what's the central bank targets. And also you can see the same for China earnings here as well, using the same forecasted earnings growth model as well as the EPS trends going forward. Now here you could see fund flows generally for this year, given the trade war and also given a lot of flight to safety across assets. We've seen that the sentiment towards the U.S. has been much better relative to emerging markets so far this year, and that's across all asset classes, equities, bonds, money markets, and investors generally are right now have been shunning the high-risk equity markets. So you could see developed markets have generated a bulk of the year-to-date fund flow so far, but we're expecting that to actually reverse backward, particularly when the U.S. dollar comes back down, and we see that the inflationary pressures are actually not as high as expected. Now, finally, I just wanted to go very quickly into some of the opportunities that we see. For example, from various countries, from a PE, PB, dividend yield valuation perspective, these are some of the average scores versus the five-year historical averages On the bottom left, you could see some of the countries and also the year-to-date market performances. But I think more importantly, on the bottom right-hand side, you could see some of the what I call a top-down ESG risk scores. So we're also looking at overall risk in terms of political risk, which is government instability, economic risk, which is the risk of recessions, legal risk, enforcements, as well as the operational risk for businesses operating within countries. So overall, the risk outlook for all the countries you could see is relatively stable, particularly actually except for Hong Kong, which is a slightly higher risk going forward in the outlook. But overall, we are seeing that there's not a very high risk among emerging markets, and particularly the countries that do have various subsectors with high risk, we are seeing that risk coming down. So we do see that the stability, the economic political situation is very conducive. We see that the inflationary pressures for most emerging market countries are well controlled, and we think that the real GDP growth will actually be sustainable at a very high level going forward. So we are fully invested in the region, and we particularly think that the emerging markets relative to developed markets in the U.S. going forward would be a very attractive investment. Hopefully that fulfilled, I guess, the time. I have, I think, about 5 minutes left for Q&A.
Oh, that was terrific. I mean, you did fit it all in the very limited time you had.
Thank you for an insightful presentation. One question I'm curious about as you do your analysis. In China, most of the companies that I've dealt with in the chemical industry, petrochemical, et cetera, work on a 2 to 3% margin, whereas here in the U.S. we work on a 10, 20% margin. You integrate those numbers into your numbers or normalize them, or how do you approach that when you do your analysis?
Well, great. Thanks for that question. I think if you look at Chinese companies particularly, I agree that a lot have very low margins, and thereby you could actually see very high volatility within A-share markets. And A-shares have actually recently been included in the MSCI indices, so actually that's capturing a lot of international investor attention. But going to your question about low margins, I think that it's not particularly the level that I pay much attention to, but particularly the trend. Do I see that from a low margin level, are these, particularly in your case, chemical companies improving those margins over time? And is that coming from better, top line growth? Is that coming from cost cutting? Is it coming from better productivity, automation of systems? So I think for me, particularly if an industry has low margins, I would consider that to be quite a norm. I wouldn't actually shun away from a particular industry or sector, but look into particular companies that have very strong business models where they would be able to improve margins or improve profit growth over time.
Okay. Jimmy, thank you very much for your insightful presentation. You just talked about emerging markets. Could you share your opinion about the sectors? What kind of sectors probably we should pay more attention in these countries? Particularly, you mentioned like China, India. Could you particularly talk about the rising sector or the future star sectors in these two countries? Thank you.
Okay. Sorry, you were asking about the sitters?
Sector industries.
Oh, the sectors, correct. Well, I think, U.S. I think we've all seen that Apple, Google, Microsoft has been very, very well, and I think part of that is due to that economic growth cycle that's very, very strong. China particularly, and I can go into more detail here, is undergoing a deleveraging cycle. And through this deleveraging cycle, I think it's it's a consensus. Now, whether you believe China's GDP figures or whether you think it's fabricated, I think the one thing that we can all agree on is that China GDP figures are going to be trending downward. And I mentioned that investments are actually are slowly coming down. Exports are actually at risk, and consumption is slowly going to be taking a bigger part of that. But it's a very slow-moving process. Now, I think that the key sectors for me is one, consumer discretionary, where I believe that the rising China consumer wealth would lead to greater spending, and I think that this is associated with various key industries, including dairy, for example, premiumization of foods. We could talk about milk powder. We could talk about baby strollers. Actually, the government has actually slowly loosened the rules in terms of the one-child policy. Now we had two-child policy, and now it's actually families are allowed to have as many children as they'd like. So, that likely would spur much higher consumption. And I think that the government is really promoting that and promoting industries where the consumer makes up a bigger part of the overall economy. So generally, I wouldn't look at SOE companies. Just SOEs generally I'm not too focusing on the profitability bottom line, and that includes, for example, the banks, the railroads, some of the energy companies, but particularly some of the consumption names, staples names, information technology names. So some of the key names are Tencent, Alibaba, very much related to China consumers through the WeChat, which is the China equivalent of a WhatsApp. But you could see that a lot of the Chinese citizens actually pay through the WhatsApp WePayment instead of actually having cash. And I think that that's one area that China is actually more advanced than the U.S. In terms of having technology and having mobile devices and having innovation among electronic payments. So I think that information technology with payments, consumer discretionary with spending, those are some of the key industries that you really want to be invested in for the long term.
Thank you very much, Jimmy. You mentioned tail risk earlier on in your presentation as a caveat. I'm wondering if you can talk a little bit about how you build that into your model, whether you're thinking about it from a trade war perspective, economically, from a security perspective, South China Sea and competition between the U.S. and China. And then finally, I'm just curious, you mentioned consumer growth and demand in China. Can you also just say a few words about what you think the Belt Road Initiative will do from a China perspective as far as developing the economy and how that complements maybe the points you made about domestic growth and spending?
Sure. Well, just go to your first point. Tail risk. Very hard to really foresee the tail risk before it actually happens. And then when it does happen, everyone kind of looks back and say, oh, how come I didn't see that? But, you mentioned South China Sea. Everyone talks about North Korea risk. To me, that's actually not a tail risk, particularly for investors in Asia and also for Hong Kong and China. South China Sea, North Korea, these are actually just noises. So if there is a sell-off or certain risk-off events, these are actually moments where we actually want to take advantage of that and actually buy on the dip. Now, a real tail risk event is, particularly for China, is when you're seeing massive deleveraging, massive financial tightening, a collapse in the housing market, and a loss of wealth, and particularly a trade war. Now, the trade war part is more related to a huge rise in tariffs, a huge spike in U.S. dollar, and a huge increase in a larger than expected interest rate increase, which would thereby spur massive outflows in emerging markets, and particularly for China and Hong Kong. So I think for tail risk events, we highlight some of the more higher probability events, for example, the housing, for infrastructure, even the trade war. And we factor in, for example, if the central bank decides to raise rates or cuts RRR by X amount, how would that financial tightening situation affect the stocks or the companies within our portfolios? And then we would factor that into our models. Now, going to your second question, the One Belt, One Road, this is actually not a new concept. It's actually, I think when it was announced back in 2015, I think, it drew a lot of attention, and I think it has a lot of buzz. But I think over time, it's actually wound down a little bit. And a part of that reason is because a lot of the countries that are participating in the One Belt, One Road are actually have very low credit scores, actually have very high debt. And the situation for One Belt, One Road, I think it's becoming much more crystallized, where investors see this as an opportunity for China to really just grab more power within the region and thereby be able to compete against China, against the U.S. as a superpower. So I think as an investment theme, it's very challenging for an investor. We've looked at that. We've looked at the key themes. We've looked at companies, even countries associated with it. But given the high risk, low return, low ROICs, low ROEs, it just doesn't make financial sense from an investor's perspective. But I think from a from Chinese social responsibility perspective, certain companies and also the banks are essentially forced to take on some of these loans, and thereby there's an overhang among the Chinese banks on whether or not their balance sheets are actually reflective of what they're actually showing. So I think the theme is great, the story is great. I think it's much more political than economical, but from an investor perspective, it's not something that I'm very excited about.
Jimmy, thank you. Thank you very much. It's been a wonderful table setting for the whole morning. Thank you. Let's give Jimmy a round of applause.